And so what we've noticed is a lot of the failures happen with people that haven't taken any or very little debt, or those that have taken too much debt. The best range is something between 40 to 60% debt.
I'm here at PDAC 2016 with Joe Mazumdar from Exploration Insights. Joe, thanks for joining us today.
Thanks for inviting me.
For the benefit of our viewers who weren't able to make to your talk, can you give us a few talking points?
Well, what I talked about in the presentation was really about capital structure. So we went through all the major risks for a mining company, which are a lot. But what we said was that over the past 3 to 5 years, not very many people were financed. But then we looked at who was funded, and what we noticed that even though they got funded, we still had failures. Does the capital structure of how people funded themselves, equity, debt, streaming, what have you, does the proportion, or is there something in the tea leaves of that could tell us that this project would have had a higher probability of failure? And what we noticed was on an absolute basis that companies that tend to raise, let's say 40% more than what their initial capital estimate is trying to tell us that the scope changes in this environment of no escalation is too much. There's something wrong. And when they're underfunded, when they are raising less than 20% of what they need, then we think that they probably need to go back to the market. There's a nice range of about 18 to 22% over what they need that seems to work to do your working capital. Then the other issue that we have is due diligence. The highest level of due diligence that we consider appropriate for a mining project would be what comes with debt holdings. And so what we've noticed is a lot of the failures happen with people that haven't taken any or very little debt, or those that have taken too much debt and have working capital issues trying to service it. The best range is something between 40 to 60% debt. Mm-hmm. And then we also talked about streams, so the people that get funded too much with streams, historically right now over the last 5 years, has not been a great level of due diligence.
So there's that sweet spot that you want to look for when in the funding range for a mining company.
That's right. And that would tell you that with enough debt, 40 to 60, there has been some due diligence done on it at a certain level. And then with the streams, tends to be not the lowest form, but not something a CEO would tell you that they would be looking for first with respect to funding their project, because it tends to hinder the leverage and also takes away some of the exploration upside. Although, people would argue that, hey, Endeavour took over True Gold, they had a high proportion stream for their financing. But my question really in the end is, does that change the asset quality?
Do you think it on the horizon we'll see a funding window open up for mining companies, especially for juniors? Well,
every quarter, like the first part of the year, January, February, over the last few years, we've seen a big spike in funding, equity raises, and then it just goes to nothing, and it's dead almost till the end of the year. We're hoping, that would be an indication that the interest is reviving, that we'll see a spattering of financing going forward. And the nature of the financing is also what we got to look at. Was there a lot of warrants involved? Are the deals bought deals, or are they best efforts? And how quickly does the deal close? Are they over allotted? Are they oversized? Those would be the indications that really the market's picking up.
Joe, are there any picks that you like at this time, and why?
There's no real, hey, this is the best stock out there. There's a certain risk and there's a certain reward that you're going to look for, and really what you're trying to look for is that best profile. And when I first started for Exploration Insights, where we saw a lot of good risk reward was in the mid-tier and the smaller junior plays like the Clods and the Lake Shores. As the market progresses and people are comfortable with 1250, 1300, we should see a lot of that sentiment coming down market to the developers, which we've seen some of these guys get decent returns, and then eventually to the explorers.
Joe, where can our viewers go to find out more information about Exploration Insights?
We're basically a subscriptions newsletter, and it's www.explorationinsights.com to subscribe, and then you also can get free reports there.
Joe, thanks again for taking the time to speak with us today.
Okay, thank you.
For SmallCapPower, I'm Angela Harmantis at PDAC 2016.